So I came across this photo on Facebook. I'm dead serious when I say iron condors are the ultimate strategy. And it got me thinking because these results aren't something that you can just ignore if an iron condor can do this to your P&L. If you don't know what an iron condor is, don't worry. You're in good company because I didn't really fully understand it either. So I had ChatGPT explain it to me like I'm 5. Imagine you have a playground with a big slide. You want to keep your friend from going too high or too low on the slide. So you make 2 rules. They can't climb higher than the top of the slide, and they can't go lower than the bottom. To make this happen, you set up 2 fences, one near the top, one near the bottom. If your friends stay between those fences, everyone plays happily and you get a prize. But if they go outside of it, you might lose some of your prize. An iron condor is like setting up those fences in the stock market. You bet that a stock will stay in a certain range, and if it does, you make money. That was a little bit of a convoluted metaphor. So let's hop into the options chain so that I can showcase this to you more visually. In ThinkorSwim, you can add simulated trades so that you can see the risk profile of your exact options trade. So what we're going to do, I'm going to right click here at the 605 strike on SPY. We are going to analyze actually a sell trade, because actually what that metaphor was describing was selling an iron condor from the best that I can understand. So let's analyze selling an iron condor. That's going to set up our trade down here automatically. Then if we click into our risk profile, you will get an idea of what's going on. If SPY stays between 603 and 605.5, we will make money up to a maximum profit of, if I could hover, $640. Else, if it falls outside of that range, we will lose money with a max loss on both sides of $330. Obviously, this is for selling an iron condor. So if I wanted to come in and let's then go analyze instead at the same strike, buying an iron condor, this is of course going to do the inverse of the metaphor. Now we were going to make money only if SPY breaks below 603 or above 605.5. If it stays between that range, we are going to lose money. So I'm looking at this risk profile specifically now of selling an iron condor, and I'm thinking, so okay, I have set this up to now just be one contract. If I sell one iron condor at the strike price that expires tomorrow on SPY, I can make $63 if we stay between this range, or I would lose $33 if we end up falling outside of this range. That's a really nice risk reward. I wonder if there's a way that I could find statistically how often SPY moves a certain percentage. Then if I could extrapolate that data and look at it compared to the risk reward of the options trade, could there be statistically proven trades that could be taken? The likelihood that SPY is going to remain in this range is greater than the 2-to-1 risk reward that we are taking when placing this trade. So I coded the following custom study. This is plotting the low and high of a 1% change from the closing price of the previous bar. Then up here in plain English, you have 4 labels showing you the number of days we have closed below 1% out of the last 100. So 8 days out of the last 100 days, SPY has closed 1% lower than its previous day close. 12 days, SPY out of the last 100 days has closed above 1% greater than yesterday's close. That, of course, provides us with 8% of days being down more than 1%, 12% of days being up more than 1%. Now, I built this study to be fully customizable. It's called DTS percent difference. If I come into the settings cog here, we can instead change the percent distance. Let's say I want to see how many days out of the last, now let's look at like 25 rather than 100, that we have had either a 3% move up or a 3% move down. Go ahead and hit apply on this. On SPY, it's probably never happened. It hasn't, at least, once again, not in the last 25 days. Let's go to something a little bit more volatile. Let's look at NVIDIA, and you can read this now. It even changes the text in the labels. 3 days closed below 3% out of the last 25. 3 days closed above 3% out of the last 25. And it, of course, recalculates your percentages. That is 12% of days being down, 12% of days being up. Also, just so you can see here, if you don't want to see specific labels, like maybe I only want to see the percentages, I don't care about those reads, or obviously vice versa, those settings can be changed here. Also, maybe you don't want the plots on the chart. Maybe it's a lot of lines, gets in the way of your other analysis. All you need to do, turn off the plot bubbles, or bubble check marks is there, should I say. That will turn off those lines on your chart as well. So the study is fully customizable. So you'd run this study and begin to take a look at the results. I've gone back to the original 1% move out of the last 100 days. On SPY, 8% of the time, we have closed down below negative 1%. 12% of the time, we have closed with a gain of 1% or more. Those two numbers added together obviously equal up to 20%. So 1 out of every 5 days, SPY is likely to close between negative 1% and positive 1%. We are also provided by this study the values that this percent change would be tomorrow. So tomorrow on SPY, 1% down would land just under 599, 1% up would land just under 611. So let's go ahead and hop back into our simulated options chain here, and let's just take the at-the-money strike of 605, and let's analyze selling an iron condor. Clicking into the risk profile, we can see that we would make money if SPY closed between 604.5 and 607. Well, that's not really wide enough, 604 and 607. We're looking at 599 and 611, right? Two different ways you can go about this. One, you can adjust the strike prices on your calls and puts for the iron condor. From what I can tell, you build an iron condor by buying 2 calls and 2 puts, you buy a call and sell a call, and then you buy a put and sell a put, but you do them at the nearest strike price to one another. So let's go ahead and look up at that 609 level or 610 level that we're looking at on the calls for our upside, and the downside was right around that 598 level. So we go ahead and put 598 here and 597. I believe those were our numbers, right? 598 and 611. Yep, close enough to our numbers. So now we can take a look. Of course, our break-even points are between 598 and 607. Just like the spread looks on our chart. And we know tomorrow we're going to have a 1 in 5 chance that SPY is going to, 4 out of 5 chance that SPY is going to close between those two values. Great. It's likely to happen. Now, of course, just because it's likely to happen, you have to take win percentage multiplied by risk reward. That is trading, right? What the study is doing is it's helping you quantify win percentage on an options trade, which is amazing. Now, what this risk profile is doing is it is showcasing you your risk reward on that trade. If we go ahead and bump this down, let's go with 1 contract. That's a little bit more realistic for most of us. We will make $4 if we close between that range. And if we don't, we will lose $96. So we have a 4 or 5 chance of being right. But if we're right, we only make $4. If we're wrong, we lose $96. That is not a 1 in 5 or 4 in 5, however you word it, risk reward. This is not a positive trade to take. Now, the better way we can go about this is we can once again look up the sell of the iron condor at the current strike. So let's take the 605. Let's analyze a sell trade of an iron condor. Looking over at our risk profile, our range for profit, once again, that SPY needs to close between tomorrow is 604.5 and 607. What we could then do is we could come in and we could adjust this percent difference to land around those instead, 604.5 and 607. Let's try something like 0.25%. If I type this in, we go ahead and start looking. Okay, here it is. Cool. We got 603 and 606, so not quite that 604 and 607. Let's try to widen it just a little bit. Let's go 0.35 instead, 602, 607. So you're somewhere right in this range, somewhere right in that 0.3% change range when talking 604, 607. Call this close enough. With these statistics, remember, your labels here are auto-changing. 23% of the time, the stock SPY, should I say, has closed below that negative 1%. 42% closed above that positive 1% out of the last 100 days. Add those two numbers together, that is 65% of the time we are closing outside that range. Okay, so just over half the time, we are going to close up or down more than the 0.3% that is essentially brought to us by this spread we're looking at. So what is our P&L? If we land in this spread, our max win is something like 680, but let's kick this down to one contract, a little bit more realistic. Our max win is $68. That's what we're likely to make if we close between that range. If we lose, we're only going to lose $32. Now that looks really nice. 65% chance that SPY won't close between this range. So something like, what's the math there? 35% that you're going to win in this. But if you win $68. If you lose $32. That is over a 2-to-1 risk reward. And a 2-to-1 risk reward at a 35% win rate, I believe that is the break even for a 35% win rate. I actually went and had ChatGPT do it for me because I'm not very good at math, but you can see at a 35% win rate, the break-even risk reward is approximately 1 to 1.86. Let's remember our trade here. If we are correct, if it closes between this range, we are to win $68. If we're wrong, we are to lose 32. So let's take 68 divided by 32. That gives us a risk reward percentage of 2.1. That is greater than the break-even 1.8 or whatever it was that's needed. That makes this a profitable trade setup. Now, there are some flaws with this logic. First off, our break-even points on our trade are 604.5 and 607. The numbers we're using for our statistics instead are 602.87 and 606.49. So not exactly the same numbers that we're performing our calculations between, but I want you to take a look at what this simple study now has you doing. It has you thinking about statistical probabilities behind your options trades rather than just buying and hoping. Also, we are doing this against the SPY options chain, which is either number one or at least up there in the most heavily traded options chains. That's going to make it very hard to find inefficiencies in this market. The options market is extremely efficient. It's very rare you're going to be able to find mathematical, profitable probabilities, that was a mouthful, in this options chain. But who's to say that you can't look at maybe some other, less heavily traded ones and not find some of those statistics that you can then pull and take profitable trades on. Once again, does that mean you're going to win every trade because you have a study like this? No, that's not the point of this study. The study is so that you can now perform win-loss percentage calculations and run that against the risk reward of the trade you're about to take. And that allows you to build profitable trades. You're not going to win every trade, but you're going to be taking profitable trades. And iron condors are just the tip of the iceberg for this thing. That post about iron condors just gave me the idea to build this, but really you can use this study to help build out your win percentage versus risk reward on any type of options trade or even regular stock trade. We're back on SPY and we're back on the 1% out of the last 100. 8% of the time out of the last 100 days, SPY has closed down more than 1% from previous close. There's a 92% chance that tomorrow SPY is not going to close below 599. You could then take that information, hop back over to the options chain. The $5.99 put is currently selling for $9 a contract. There's a 92% chance that you can sell these and collect on $9 for every contract that you sell. You could then extrapolate that data to help you determine, okay, what am I willing to risk at a 92% win rate in order to make this a profitable trade? Once again, I don't really do math. I just have computers do it for me. So I've asked ChatGPT, at a 92% win rate with a $9 reward, what can I risk to still have positive expected value on the trade? It has shown all its work, like any good middle school math teacher would want you to do. Come up with the answer that you can risk $103.50 to maintain positive expected value. So you'd want to lower that to be profitable. So say you're going to risk $80 for every contract that you sell on that $5.99 put. Was it $5.99? Yes. Put you're going to sell on SPY tomorrow. So you're going to sell 10 contracts. You're going to risk $800 to potentially make $90. Now, that doesn't sound very good. Trey, why the hell would you risk $800 to make $90? I get it. Doesn't sound good. But at a 92% win rate that you now know because of this formula that you have on that trade tomorrow, that is a very profitable trade for you over time. You do that trade a million times, you're going to likely, no promises, of course, you're likely going to make a lot of money. And without this study, you would not be able to perform that calculation. You can have the idea, hey, SPY doesn't drop more than 1% a day very often. So I'm going to sell a put 1% down every single day, 0 DTE options. That's all fine and dandy to have that trade idea, but how do you know how much you're allowed to risk in that trade for it to still be profitable? Without having any idea of what the actual win percentage of that trade is, you don't know what you're allowed to risk before this no longer becomes a profitable trade. Because it's not a profitable trade just because you can sell puts at 1% down and make money. It's only profitable if you understand your risk, if you're exiting your loss at the right point. If you're instead losing $200 every time the trade goes against you rather than the $80 that you now know is profitable, you're not going to make money. You can have that same exact trade idea and you're not going to make money because you're not limiting your risk right, which now, of course, you know how to do because you have this study. I could go on and on about use cases for this study. Once again, it doesn't even have to be options trades. You can do very similar calculations to what we were just doing for just normal stock purchases, for either where you would like to take profit or where you would like to set your stop losses to help you determine how often those stop losses are triggered so that you can help determine your position size so that you are taking statistically likely profitable trades. However, let's go ahead now and quickly showcase to you how you can all get this study onto your own charts. The study will be available for easy import over on my website, daytradingstrategies.net. There will be a link in the description of this video. You're going to navigate to our codes. This is, of course, where you will then sign up, create an account, navigate to ThinkorSwim, and then navigate to studies. You're, of course, going to want to scroll all the way down to the bottom as I'm making this video. This is, of course, my most recent study added to the site. It is called Percent Difference. You're going to scroll down. You're going to find that, and every study on this page comes with a share code. All you need to do, copy down this URL, then navigate back into your ThinkorSwim, set up in the top right, open shared item, paste, preview, import, then of course, add the study to your chart just as you would any other study. From your edit studies modal, type in DTS. That's what I have them all prefixed as, and you will find DTS percent difference. Add it to your chart. You will have this exact same study with all the customizations available to you so that you are then able to build real statistical trades out. Once again, that's daytradingstrategies.net. Navigate into our codes, and this is where you're going to sign up. There are over 75 codes, guys, that you get access to all of them for one low price. I don't charge buy the code or anything. You're going to get access to all 75 custom studies, scanners, and even trade strategies within ThinkorSwim, all for this low price. You're not going to find value like that anywhere else to get a better head start on your journey towards becoming a profitable trader. And please, once you're signed up, don't feel like you're locked in. At any time with just 3 mouse clicks, you can cancel under the My Account tab. I have it set up as a subscription because I am always adding and updating codes to the site. As you all probably know, strategies and indicators don't remain perfect forever. The market is an ever-changing environment, so it's important to always be updating and optimizing your codes. That's why I have my site set up the way I do. But once again, if you just want to download what's currently there, then cancel. Fair enough. Do what you would like to do. But daytradingstrategies.net, our codes. Go get signed up. Become a better trader today. So not only did you learn about this study in today's video, that was almost the background topic of discussion. The real central idea, what I really want you to take home from this video, is that idea of calculating win percentage times risk reward. You should be doing that in every single trade you take. Does that mean you're going to start winning every single trade? No, of course not. But it's like being dealt aces in poker. You're not always going to win with aces, but if you get dealt them, your job becomes to get all the money in the pot pre-flop. Because even though you're not guaranteed to win, whenever you are likely to win, whenever the odds are in your favor, that's what you should be leveraging to make money in this game. So hopefully you learned something in today's video. If you did, please take the half second, hit the like button. Really means the world. If you would like to continue learning, make sure you're subscribed. It's free. Click that red button down there. With all that being said, I'll catch you all in the next one.